And it's a beautiful Friday morning right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live on Channels Television. I'm Ladi Williams. First off, let's kick off with markets. Starting with the oil market, we see Brent futures for July delivery fell 36 cents to $111.68 a barrel, while the U.S. West Texas Intermediate crude fell about 36 cents to $111.85. It's on its last day as a front month. WTI futures for July, which will soon be the front month, were down about 0.6% to $109.20 a barrel. Well, joining us to discuss performance and outlook for global financial markets and the commodities market, we have Babajide Atolagbe, Treasury Analyst at AfriInvest Asset Management, joining us on the program. Good morning.
Hi, good morning, Ladi. Thanks for having me.
Great to have you. Well, the global commodities market have remained volatile. What would you say drove sentiment in the oil market? We've seen that seesaw movement week after week. What happened in the market this week?
This week, you're very right. The market has been neither here or there. We've seen a mixed sentiment, right? And on the bull side, we've seen that the improvements in the lockdown situation in China has prompted some sort of nice sentiment in the market, because we all know China's position in terms of global oil import. So lately, China has gone into a lockdown to control the outbreak of COVID-19 challenge that you are currently facing. Just last week, we saw new data from the Chinese government that they had little or no cases recorded in the week, and they are looking at reopening some key cities, right, to continue to improve economic activities. So that sentiment has brought about, investors, oil traders wanting to buy and wanting to speculate longer. And on the flip side, right, the Russia-Ukraine crisis continues to dampen sentiment. It's really a tussle in that space, as global leaders are beginning to look for ways to actually sort out the supply imbalance that was brought about by the war. At the early part of this week, we saw that the U.S. government entered into discussion with the Venezuela government to see how they could, bring back Venezuela oil into the market. And we all know the reason why the U.S. is trying to do this. They are trying to do this in order to, put a balance to the oil market and to allow oil prices to fluctuate. So it's really been a difficult week for oil traders. We've had fair shares of bullish runs and bear runs. So it's a mixed performance this week.
Quite a mixed performance, but they have had quite a lot of profit, made from that market with oil traders. But gold and other precious metals took a rebound this week. What is responsible for the uptick in prices for those metals?
Yeah, for the precious metals, particularly gold and silver, we've seen that as investors begin to shy away from the macroeconomic risk in the environment, they are beginning to buy more into precious metal. We also observe that in the U.S. market, a lot of volatility has happened in the equities market. Same has happened across other risk assets because of the current macroeconomic fundamentals stemming from higher inflation, stemming from policy normalization across advanced economies, and a couple of other supply-related factors. The risk in the investment arena has really gone up. So it is just rational for investors to begin to seek investment in safe haven, which is responsible for the slight uptick we're seeing in the commodities, in the energies, in the precious metal market, particularly gold and silver, like you rightly mentioned.
Right, and we know how traders love their safe haven assets. But let's look at the bond market now. The sub-Saharan Euro bond market recorded high sell-offs this week. What do you think caused that?
For that space, right, we observed that the market has been tracking the performance of what's happening in the global equities market, specifically the U.S. market. We understand fully well that because they have the same risk appetite and they have the same risk nature, so we understand that prices tend to follow what's happening globally. And like I mentioned, the U.S. Market has suffered heavily from high inflation worries and policy normalization. So we saw the sub-Saharan Euro bond market taking a toll from what's happening in that space. So throughout this week, we saw downtrend in prices, particularly on Nigerian instruments, as investors are beginning to rotate out of risk-weighted assets, like I mentioned, and move into developed market bonds. Because we saw a correction this week. This week, developed market bonds actually moderated in terms of yield, which means price went up. And we could drive that event to the fact that investors are running out of risk-weighted assets like sub-Saharan Eurobond market, and they are tilting or pushing their investment toward a much more stable and safer form of investment, which is why you see bonds market gaining this week in the developed market. And also we see why the precious metals market also gained. So by and large, we've observed that the risk nature is very, very high. And the major risk factors are higher inflation in US, higher inflation in UK, and the fact that the US Fed is also looking at increasing policy rates at a faster rate. We saw that in March and in January, they discussed raising rate by 0.25 and 0.5% respectively. But the US Fed chairman has also put it to the market that the possibility of a 75 basis point increment in yield in benchmark rate is still on the table. And of course, market participants are very, very wary of that, because anytime you see an increase in policy rate in advanced markets, it usually takes a toll on many asset classes, particularly fixed income. So the sell-off we're seeing in the sub-Saharan Eurobond market is largely connected to the discussions in the global space.
All right, thank you so much, Babajide Atolagbe, Treasury Analyst, AfriInvest Asset Management. Thanks so much for coming on the program. All right, so after the break, we'll look at Nigeria's foreign exchange market. That's in a moment. That's our next conversation. Do stay with us. This is Business Morning. Welcome back now to our next conversation. With the volatility in the FX market, the Nigerian naira fell to about 604 naira to a dollar. The parallel market from 565 at the start of the year, consistent with 39 naira loss year to date. Meanwhile, trading at about 490 naira to the dollar in the INE window. For more now, we have Patrick Kuran, senior economist at Telema, joining us right here on Business Morning. Great to have you on the program.
Hi, good to be here.
Yeah, so from your point of view, why do you think the Naira has lost so much value in that parallel market, and why are we seeing so much volatility?
Ultimately, for the past year or so, the Naira has been pegged around 410 or 415 to the dollar in the official market, which in our view is an overvalued rate. So in this type of situation, really the parallel market is the only safety valve for price discovery, for the true value of the currency. So I think the depreciation really is reflecting a fundamental mismatch between supply and demand in the market that's trying to be satisfied in the parallel market.
Right, and the difference, between the INE window and the black market is expanded by about 188 naira. What do you think is the economic impact of this disparity?
Sure. I mean, the CBN stated rationale for pegging the currency for a long time has been to protect ordinary Nigerians from the impact of inflation. But of course, the longer that the overvaluation and supply shortages have persisted in the official market, the more goods have begun to price off of the parallel market anyway. So effectively, it passes through to inflation in the same way it would if the currency was devalued in the official market. It pushes up the prices of goods, but it's something that would happen regardless of the mechanism. If it depreciates in the official market or the parallel market, either way, inflation becomes higher.
And what do you think, could help strengthen, the Naira to the greenback at this point?
Yeah, I mean, it's a difficult question, and I think really it's a two-part question, because the first part is, I think, really what needs to be done to strengthen the Nigerian economy, and I think a big part of that is more flexibility in the official exchange rate market. So regardless, with the Naira being overvalued right now, there needs to be further depreciation to make the exchange rate competitive, to make Nigeria's non-oil exports competitive, and to restore supply and demand balances in the foreign exchange market and attract investors. So a devaluation really is an essential component of Nigeria's longer-term growth outlook. That said, to make it strengthen in the parallel market, I think the solution is quite similar. While I think is overvalued, I don't think 600 to the dollar is the appropriate valuation either. So really, I think if there was more flexibility in the market, the two exchange rates would probably meet somewhere in the middle.
Right, and we've seen the greenback, hit new highs, with the DXY hitting a high of about 104 points, to a basket of other currencies. How has this, strengthening impacted, most currencies in emerging markets like the Naira?
Yeah, the Naira, like all currencies, has been impacted by the dollar strength this year. It's up about 5 or 6%. This is partly a reflection of rising global risk aversion towards emerging markets and more broadly speaking. Typically, when the dollar does strong, most emerging market currencies perform weakly. And it's unclear if this strength is going to continue moving forward, if the dollar is going to continue to act as a safe haven currency, or if risks domestically in the U.S. About fears of recession and high inflation will start to dominate and cause the dollar to moderate.
Right, and the U.S. dollar index, seems to be pulling back a bit. It's about 102 points last time I checked. Do you think, the dollar has peaked or about to peak?
It's a really good question, and one I wish I had the answer to. I think the dollar, many people thought was overvalued headed into this year as well, but given its role as the global safe haven currency, has continued to strengthen nonetheless. So I think there's a strong argument for the dollar needing to weaken over time, similar to the argument for the Naira. But it's just a matter of when, and that's very difficult to predict given the technical factors at play.
And if it continues to, pull back, at this point, what do you think will happen to, emerging market currencies? Do we see them strengthening?
Yeah, I think so. And to be fair, emerging market currencies have held up relatively well this year, given the rise in global risk aversion. Most of the sell-off in emerging market debt more broadly has been due to rising treasury yields. More lately, it's been related also to rising credit spreads, so increasing risk aversion in emerging markets. But overall, I think really emerging market currencies have been quite resilient this year, which has been encouraging to see. I think part of that has been emerging market central banks being very proactive over the past couple of years. The Fed, of course, just began its rate hiking cycle a couple of months ago. Many emerging markets have been in the middle of their cycle for the past couple of years. So that's helped protect many emerging market currencies over the past few months.
And we're seeing a global inflation, going up at this point. A lot of central bankers, looking at tightening, and we're seeing more possibilities of more, tightening with rates, at this point with the Fed and in the UK too. We're seeing all regulators now looking at, raising rates to, tame inflation. But if this continues, what do you think is going to happen to, emerging market currencies going forward?
So markets currently are pricing in a very aggressive hiking cycle to about 2.5% to 3% by year end. This is about the same magnitude as the past 3 or 4 Fed cycles from the historical perspective, but is taking place at a pace that's about twice as quick. And it's also taking place against the backdrop of 4-decade high inflation in the U.S. So there's a risk that markets may be underestimating the extent to which the Fed needs to hike, in which case there could be more pain in store for emerging market currencies. That said, if rates evolve in line with what markets are currently anticipating and the adjustment is more orderly, then there's also a chance that the worst is behind us for emerging market currencies. It's just very difficult to tell which of those two scenarios will prevail from where we sit now.
Right. We all need that crystal ball at this point. But,
right.
We've had, conversations about, the ECOWAS currency. That's the ECHO. Do you think it's time to, dust off that idea and bring it, into the fore?
Yeah, I mean, it's definitely an interesting policy idea, but I think the political constraints to implementing that across such a wide set of countries with varying currency regimes, many of which, like Ghana, for example, have been well served by their flexible exchange rate regimes and will be hard-pressed to give up the monetary policy freedom that they'll need to give up to have a pegged currency. I think the hurdle for that is going to be quite high. So while it's an interesting and important conversation to have, I don't see that as necessarily the most politically feasible solution to the current currency issues.
But if there's some consensus, you think it would help?
I think overall countries like Nigeria and Ghana and some of the larger markets in ECOWAS are better served by having their own independent currencies. The structures of the economies in the ECOWAS are so diverse that having a peg currency that is at an appropriate level for so many different countries with a different economic context, I think will be very difficult. Ultimately, for some countries, it's going to be overvalued. For some countries, it's going to be undervalued. Of course, like I said, every country will have to commit to giving up their monetary policy independence, which I think for Nigeria isn't necessarily the most expedient route to go.
Right, quite a lot for economies to deal with at this point, from currency, inflation, so much to unpack there. But thank you so much, Patrick Curran, senior economist at Telema, for coming on the program, and enjoy your weekend.
Thanks for having me.
All right, so after the break, we'll look at business confidence in Nigeria. That's in a moment. Do stay with us. This is Business Morning. Welcome back. Now to our next conversation. We see businesses and consumers are facing multiple challenges, at this time, with rising global inflation stoked by elevated energy costs, household incomes being squeezed, and businesses struggling with rising input costs. So how should businesses brace for a possible global recession? Because we're seeing the recession word being thrown around globally at this point. Well, we have Michael Famarati, a co-founder and head of intelligence at Stairs Business, joining us right now on Business Morning. Great to have you in the program. Good morning.
Morning. It's a pleasure to be here. Thanks.
Yeah. So quite a tough time, for businesses and households with global headwinds. But how much of a risk are these global headwinds for Nigerian businesses at this time?
Well, so I think the first thing to recognize is, as I like to say, Nigeria has been in a little bit of a recession since 2016. We never quite came out. 2020, set us back again because of the pandemic. So by and large, a lot of businesses are relatively used to that times. That said, the key difference is obviously, like you mentioned, it looks like the global economic slowdown. And that adds another dimension, particularly because the one escape for a lot of businesses over the last 2-3 years has been looking abroad. Right? Can you export? Can you get international clients? Can you get international funding? So the global landscape has been an escape for the fact that our local environment has been quite tepid for quite a while. But now it looks like, all around their problems. So it is going to be quite tough. I think what is unclear is timing. I think there's a lot of panic in global markets, mainly because the stock market is crashing. But I don't think in terms of the real economic impact that we began to see it significantly. I think that a lot of that coming.
Right, and with central bankers globally now, having that hawkish stance, looking at raising rates. What can businesses do, at this point to prepare for, more high costs of borrowing?
Well, I think the key thing is, just like you said, debt is now more expensive, funding is more expensive. And the key thing is actually that this is not just for debt. Funding across the board is going to be more expensive because debt is more expensive. So, for example, a business who may have turned to venture debt to raise a $10 million round may now have to look at private equity. And the reality is that now it's a financier's market. They are suppliers of finance are now determining the terms because the market has turned down. So it's going to be a lot more difficult to raise funding. It's going to be very important for companies to see how they can reduce their burn, cut costs if needed, because for a number of companies, particularly small businesses, which still in Nigerian economy, the key or the only objective during a recession is just to stay alive. Everything else comes up.
Staying alive, quite interesting. But we've seen high inflation and weakening currencies at this point. But there's also pressure on, employers to raise wages. But employers are also feeling the pinch with rising input costs. Where is the balance here?
Yes, so bad news is that there's no balance. It's going to be found on an industry-to-industry basis. Now, I say this because, like you rightly pointed out, costs are going up across the board. Import costs are going up, raw material costs are going up, transport costs, energy costs. Everybody's feeling it up. Naturally, those costs are going up, higher prices. The reality is that wages are a lot more sticky than prices. So, understandably so, employers will try and push back against higher wages. And do remember, again, it is now an employer's market. That is how recessions are, right? So it's going to be a tough time for workers, definitely. And, I do remember the 2016-2017 recession. You found that as the labor market tightened, a lot more people then started figuring out, can I pick up another skill, perhaps go to a master's, or can I actually start learning how to do code or UX design? And we saw a lot of migrations, newer sectors, and a lot of portfolio work because the traditional labor market was tight. I expect a similar thing this year going into 2023, as people recognize that the market is a lot tighter, they will look for alternative routes of making money, mainly through portfolio work.
Quite interesting. But what about startups now? Having to deal with, struggling for market share, then, harsh economic conditions. How do you think startups can thrive here?
Thrive, yeah. I'm not sure about that thrive. I think for a lot of startups, again, particularly if you haven't raised beyond a Series A, the goal during the downturn is to stay alive. And this is very important because we remember that startups are very young. Take a startup like Automate, and it is about 5 years old. That is a very young company. So a lot of these startups have only gone through a global boom era. 2020 COVID pandemic was the one time when things got off. But a lot of policy rallied around to try and alleviate the pain. Right? It's not going to be the same today. So for a lot of startups, this macro environment, the goal really is, being default alive, right? And a number of investors have already started advising startups, seeing how they can cut costs and reduce their burn, and also see how they can plan for contingencies in a situation where they can't operate. Because there are a number of startups who came into this year to really a seed or Series A round, but valuations are investors are focusing on using their existing funds to support their existing investments as opposed to taking on too many new investments, right? So it's a new environment. Startups we haven't really faced this kind of environment as startups. So we have a lot to learn from traditional businesses that are more familiar with the boom bust cycle. But things that used to happen before just can't happen again.
Right, I can't imagine. But, we've seen most of these startups and fintech companies, raise, record amounts, before now. What do you think is going to happen, going forward with raising funds?
Well, so the reality is a couple of things, right? One is market conditions have changed, or as they say, price has changed. Right? So startup who got into the market 3 months ago raised a fintech would have raised a 5 million seed at 20 million or 25 million plus money valuation. Now you're probably looking at raising 3 million at a 12 million valuation. So you just have to make less money. There's a school of thought that argues that is better for lean startups, disciplined startups. It makes it more likely that the better startups stand out. That's fair. It's a good argument, but nobody likes suffering and hustle. So we would much rather have all build. So that's the first thing. But the second thing is it will become easier to separate the businesses with fundamentals with those that right from the investor stage, right? Because the reality is, in a boom market, fear of missing out means that due diligence isn't as thorough as it ought to be. But in a recession, everybody's looking at every number and detail and querying it and so on. So it will make the startup ecosystem a lot more efficient long term, and that's one of the benefits. There's also the famous reality that a lot of big businesses were actually created during recessions or downtimes. And the idea there is that if you can survive being founded in 2007 and going through the Great Recession, then your businesses will be sound fundamentally, and when the economy picks up, then things right. So that's something that we can expect to see. Fewer businesses raising money, but the businesses that do raise money showing up having better fundamentals, so there'll be a better chance.
Quite interesting. And, we've seen that, fintech space, trend for a while. What do you see, as the next trend, with all these kind of new economic realities we're seeing?
Okay, so in terms of sector, I think I wouldn't call it the next trend. There are sectors that have been bubbling, but we've not quite been able to hack them. So outside fintech, I will identify e-commerce. There is quite a strong nexus between fintech and e-commerce. What we're actually seeing is a number of fintech players trying to go into e-commerce. And it's interesting because the first wave of e-commerce will be coming around. In fact, I think this week there was just a news that Jumia has finally gotten their payment license to probably launch Jumia Pay, which is in line with the traditional roadmap of e-commerce firms branching into fintech. What you see in the last 18 months is, as fintechs have scaled, they've seen potential to do a bit of e-commerce as well. So that's one industry that excites me. Another one is renewables. I think everybody in Nigeria is probably feeling the energy crisis, and the case for renewable energy, particularly solar, in Nigeria has never been stronger. The only problem is that it's a capital-intensive industry. So we're talking about how it's going to be more difficult to raise funding. A lot of these solar businesses, $10 million, $20 million, $13 million, and they need debt. So it's going to be more expensive to fund. But I think the market opportunity for renewable technology has gotten 5 times better in the last 6 months. So that's another sector that I see picking up a lot more over the next 18 to 24 months, particularly on the retail side, so households, businesses.
Right, and recently we saw that the SEC actually released guidelines, to govern that cryptocurrency space. For you, how do you think, these guidelines will impact, most of these companies that are looking to actually play in that space when it comes to DeFi and all of that?
The guidelines are a very good step. The guidelines were supposed to come out over a year ago. The CBN ban that happened changed the dynamics. I'm hoping that these guidelines will step towards a more crypto-friendly environment. The reality is current regulatory environment still is quite difficult. SEC guidelines are great, but SEC guidelines refer to crypto as an investment asset. There's a lot more than that, and a lot of the potential is still being blocked by the fact that CBN doesn't want banks to allow people to transact, to use their infrastructure to do crypto transactions. Right? So that is still a key blocker. That is still something that I would like to see. And then I would like to see CBN work with the SEC on more comprehensive rules. But let's see to what extent that comes to pass.
Right. Well, we'll keep tracking to see how, all of that plays out. But, just give me a quick outlook. We know it's a tough year. It's been called the year of the squeeze and all of that. What is your outlook for, businesses this year?
Okay, so I don't think that the local environment is going to get as bad as people have worried because of that. I think, fortunately for us, in a way, the Nigerian business environment is a bit more insulated from the global environment because dollar scarcity has made people to move away from dollar liabilities to dollar assets, right? So we're in a better position, but still, it is going to be a tough second half of the year going into 2023. And, every pre-election, we talk about policy and the economy slowing down 6 to 9 months before the elections. So when you add that to the global slowdown and the fact that Nigeria's economic fundamentals are not great either way, it's just not going to be a very good time. I would say that if I were going to advise economic growth forecast, I know the IMF last growth forecast was around 3.7% for Nigeria. 2022, I've been looking at something closer to 3%, right? Because I do think that things have changed, and we need to factor in the global environment, the energy issue, and the fact that politics are now beginning to dominate.
Quite interesting. Well, so much to unpack there. Thank you so much, Michael Famarati, Head of Intelligence, Stairs Business. It was great having you on the program, and enjoy your weekend.
Thank you.
All right, now let's take a look at what's happening in the markets. We have Ini standing by right there. How's it looking, Ini?
Well, looking good today, Ladi. I have to tell you, it's a change from what we've seen all through the week. The bull is back in charge, charging really high. Yeah, enough rest. Enough rest. Well, even though we didn't get that from our analysts yesterday, but there you have it. The market really bounced back yesterday and bounced back with a lot of strength. Over 1%, the all-share index went up yesterday. Equities cap now getting close. It went from about 4 trillion naira to 28.72 trillion naira yesterday. And there you have it. The volume was actually in the red. Value actually was very, very good yesterday, 8.45 billion naira. And the deals was less than it was the day before. And we have MTN Nigeria actually to thank for that bounce back into the market. And it seems like it's true that when MTN sneezes, the market catches cold. I think because whenever we see the market, the MTN Nigeria up, then we see the market up. Yesterday it was up, and that's why we see that the market came back with a lot of strength there. Banking actually is still in the red, so is consumer goods. The only one that made it out, just like a couple of days ago, was industrial goods. Insurance, more than 1% down there. And the market breadth also was still in the negative, so we're still clawing out of that red zone. Now, we have Richard Akimoladu now to tell us actually what happened in the market, maybe the details of it. Hi, Richard. Good morning.
Good morning. Thanks for having me on your program.
Good to have you, and it's good to have you on a day when the market is coming back. So we've been putting the good performance in the market on earnings, and I've been like, we've had earnings before, we've not had the market move like this. So what brought the market back into the bullish zone?
Okay, so as you've rightly mentioned, we saw a significant movement in the price of MTN yesterday and the like of Stanbic and WAPCO. But majorly it was MTN that actually made the market to close on a positive note yesterday. We saw the market close 1.1% up yesterday. We are still seeing all this profit taking across all the sectors, and this we might still see continue in the market even going to next week. But I'm optimistic that the bull will come back sooner or later.
Okay, so are you saying that this bull run is not going to be sustained? You see it being cut short maybe at the close of trade today?
Yeah, the profit takers, I see them coming back to the market today, actually booking profit and also self-pressured in the market. But what I'm saying is, if you look at the other markets, the money market and the bond market, rates yields are not that impressive in that in the other market. So I still see that the bull we we'll still come back to this market after we are done with these profit takers.
When do you think we'll be done with these profit takers? The way you capture them as profit takers.
So, looking at next week, we might still be seeing this sell pressure in the market. But I believe that, as I've mentioned, that looking at other markets, that what you can get there are not that impressive with what you can get from the market. And as we go into next month, we'll be in half of the year that we'll be seeing results coming to the market and also interim dividend coming to the market. So investor will always come back to take position for these interim paying dividend stocks, most especially the banking. And because if you look at the rally we witnessed lately, the banking sector were not part of this rally. So we believe that after this, that it's time for the banking to actually do their own rally, bear in mind of this interim dividend that they are coming with in the half-year results.
Yeah, thank you so much, Richard, because when you talk of banking, I've been kind of disappointed at the performance of Zenith. Zenith used to be one of our stars. But maybe it will be the turn of the banking sector, of course, when the next rally, the next bullish rally comes on. Thank you so much, Richard Akimoladu from CSL Securities. Enjoy your weekend. All right, just before we go to that break, to Ladi, let's see the other market. It's been bearish in the fixed income market. Only 13 deals at the federal government bonds yesterday worth 4.66 billion. 4 deals for the CBN bills. This is an improvement. If we know what happens at the CBN bill, mostly it's really, really quiet. Last week, Friday, it was just 0. And then the Treasury bills, 18 deals. That's a lot. Also 8.81. But we're expecting more activities here, as we have been talking about when liquidity pumps into this. But, you know, we do have that issue with JP Morgan and interest rate affecting bonds and the fixed income market. But let's keep our fingers crossed and hope that better days are ahead, Ladi.
Yeah, countdown to the MPC meeting next week. We'll see how all of that plays into the decision.
Exactly.
All right, thank you so much, Ini. All right, after the break, we head to London. Do stay with us. This is Business Morning. And right there. Great to have you, Juliana. Good morning. Well, retail sales staged a surprise recovery in April, and it's aided by strong alcohol sales. Quite interesting.
Yeah, quite interesting, Ladi. Good morning. For our viewers that are familiar with the term drowning your sorrows, I think this is what the data released by the ONS this morning points to. Quite rightly, retail sales staged a remarkable recovery in the month of April. They grew by 1.4%, which has completely erased losses from the month previous in March. The upward trend was boosted by a rise in sales in alcohol and tobacco. Off licenses boasted really strong sales in the month of April. But also as well, quite surprisingly, supermarket sales were up 2.3%. And this is despite the fact that consumers in the UK are currently battling a 40-year high inflation. I think really, not only does this point to drowning your sorrows, but I think the boost in supermarket sales does show that perhaps a lot of families are considering cooking more at home. It's much cheaper if you're buying your own ingredients and you're cooking fresh rather than going out and spending in restaurants and in hotels. But of course, there's a knock-on effect of that, which is the economy starts to slump because Britain is a services-based economy. 80% of our GDP does come from that really important base, and people are starting to feel the pinch in their pocket, which is why people are not spending more in the services, and that's why we saw a slump in the economy in March.
Right, eating out getting really expensive at this point. But now let's look at some trade matters. Now, the U.S. House Speaker, Nancy Pelosi, has warned that unilateral UK legislation, affecting the Northern Ireland Protocol could endanger British prospects for a free trade deal with the U.S. Quite interesting. What are you hearing about this?
Yeah, pretty serious. I've actually got the tweet that Nancy Pelosi, the most important speaker in the world, put out on social media. I'll just read just a small part of it, Laddie. She says it's deeply concerning that the United Kingdom now seeks to unilaterally discard the Northern Ireland Protocol, which preserves the important progress and stability forged by the Accords. This is the Good Friday Agreement. She continues, I've stated in my conversations with the Prime Minister, Boris Johnson, the Foreign Secretary, Liz Truss, and members of the House of Commons, if the UK choose to undermine the Good Friday Accords, the Congress cannot and will not support the bilateral free trade agreement in the UK. And just to remind our viewers, if anybody needs reminding, this is all about the island of Ireland. There were local assembly elections a couple of weeks ago where Sinn Féin, the kind of anti-United Kingdom party, dominated at the ballot box. The DUP, very minority, small party in the Northern Ireland, they are not happy about sharing the Stormont Assembly with them. They said they will not do that unless parts of the Northern Ireland Protocol are changed. They feel like Boris Johnson and his government completely threw them under the bus because there is now effectively a border down the Irish Sea, not on the island of Ireland, which means Northern Ireland, which is part of the UK, is still aligned to some EU rules. It is going to be a very tricky path for the Prime Minister to try and tread down because it does appear as if it's a lose-lose situation. But I think the statement released by the House Speaker Nancy Pelosi last night does show that there is still lots of international interest in Brexit. But the government have said they will be changing the protocol. And of course, we've heard what America have to say about that. And the EU said there will be a retaliatory measure because of this.
I guess the post-Brexit pangs still weighing at this point. All right, thank you so much, Juliana. We'll see you at 1:30.
Thanks, Laddie.
All right, now let's take a look at the other markets now. Let's see what the Fear Greed Index is at the crypto market. We see it's at 13 points, still extreme fear, but way out of the 10-point range at this point. But at 13, still extreme fear in that market. But traders still afraid to get into the market and trade. Market cap, $1.28 trillion. That's up about 2.65%. We see volume traded in the total crypto space. That's Bitcoin and the altcoins. That's up about 0.03% at $82.32 billion. And we see price of Bitcoin, $29,919 this morning, below the 30K range at this point, slightly. 24-hour volume traded, $34.15 billion. All right, let's bring in Michael Unaji now, digital market analyst, join us on the program. Great to have you, Michael.
Happy Friday, Laddie. Thanks for having me.
Happy Friday, and it's not that red this Friday. Quite interesting, but we're seeing the stablecoin drama still rage on at this point, and now all eyes are on Tether. That's USDT, about $9 billion in redemption in 1 week with Tether. And I'm wondering, will the Tether peg actually hold with all of this pressure?
Yeah, so it's been a really interesting week. Ever since May 12th, you saw the UST, the third largest stablecoin, peg break down basically, and right now I believe the peg is at 70 cents. And so ever since you've had that, running the bank almost to say, what you've had a mass fear in stable coins. So you've seen people try to redeem it, or if not redeem it, they've tried to move to safety, namely USDC, because they're more publicly auditable. They have more like attestations. They just have more disclosures than USDT. And another thing to note is that, USDT had at one point had more than 40% of their backing of their assets in commercial paper, and it was only after the scrutiny that they faced in the last 6 to 8 months that they switched it over to mostly commercial paper. However, though, they still have $20 to $30 billion worth of commercial exposure. So the key thing here is, even if they were to sell all their securities to help all the investors redeem their their notes, their stablecoins, the only problem is what happens when they get to the point where the only thing left on their balance sheet is the commercial paper, because commercial paper isn't as liquid as treasuries. Treasuries you can sell in a day, plus 3 days. So at the end of the day, they have illiquid assets on their books. And so the market is just stress testing them to see, hey, you guys say you have $78 billion in reserves. Well, we're going to redeem $9 billion and see if you guys are going to break a sweat. And so successfully, they have done it. And so they haven't broken down. The peg's still there. However, though, there's still more tests to come. Because as we know, their corporate debt that they use to have assets on their books, that could be something that can come back to haunt them. Because unlike USDC, which is mostly government securities and cash, USDT is a mix of 70% government notes and cash and 30% commercial paper. So the big stress test is what happens when they unload all their treasuries and are left with commercial paper. Will that be as liquid? And if it's not liquid, will we see a depegging event in that play? So, I think this
that'll be devastating to see. Yeah, well, talk about stress testing stable coins when traders are really stressed in the market right now, Michael. But it'll be interesting to see how all of this plays out. So it almost seems it's better to just stay in the volatility if you can't trust the stable coins.
Yeah, no, yeah, it's better it's better for you to be in physical fiat. Most people have forgotten that stable coins are a way to move money.
Right.
It's not really a way to store money.
Right.
So it's
all right.
more so
I guess
for,
cash is king right now, Michael.
Storage.
Quite interesting. All right, Michael. Yeah, I guess cash is king at this point.
Yeah,
physical cash, that is.
Physical cash.
Physical
coins.
All right, Michael. Thank you so much. Always good to talk to you. Enjoy your weekend.
My pleasure.
All right, that's it for the crypto market. We see it's mostly green this morning with Bitcoin recovering, above that 30K level, but still a lot of stress, in that market right now in most global markets. Anyway, that's a wrap on the program for the week. Thank you so much for being a part of it this week. And don't forget, we still have Business Incorporated at 1:30 for more updates in the world of business. Thank you for watching. I'm Ladi Williams. Bye-bye.